Welcome back, everyone. We're diving into the world of focus investing today.
Oh, yeah, this is going to be interesting.
It is. It's a strategy that Warren Buffett, really made famous.
Right?
We'll be using Chapter 10 of the Warren Buffett Way
Cool.
by Robert G. Hagstrom.
Sounds good.
It's think of it like a crash course in building a killer portfolio, like a pro.
Awesome.
Yeah. We'll learn why sometimes less is more and how to find those, what do they call them?
Oh, the elephant investments.
Yes! The ones that can really make a difference.
Yeah, those are the game changers for sure.
Absolutely. So the book starts by kind of comparing two different ways people manage their portfolios.
Okay, yeah, familiar with those.
Active management, where you're constantly buying and selling,
Right, yeah.
trying to outsmart everyone else.
Mm-hmm.
And then there's index investing,
Right.
where you just follow a benchmark like, the S&P 500.
Yep, makes sense.
But then it throws in this third option, which is focus investing. Yeah. Now, speaking of active management, the book kind of points out that it might not be as great as people think.
Oh, really?
Yeah. Did you see that study they mentioned?
No, I don't think so.
Fewer and fewer active funds are actually beating the market in the long run.
That's pretty surprising.
It is, right?
Yeah, I would have thought more would be successful.
Exactly. So even index investing, which is generally, a decent strategy, especially if you're just starting out,
Right.
it basically just guarantees you'll get, the average market return.
Right.
Nothing more, nothing less.
Yeah.
So focus investing is carving its own path here, but how does it actually work?
Okay, so the main idea is to find a handful of companies, maybe like 10 or 20,
Okay.
that you really understand, and you believe, deep down, that they've got a good chance of doing better than average over time.
Okay, so it's not about spreading your bets all over the place?
Nope. It's about putting your money where your conviction is. And then, really important, being patient.
So no jumping in and out of stocks every other day.
No. This is long-term thinking, like years, not minutes.
That's where those focus investors' golden rules come in, right?
Yes, those are like the core principles.
From the book.
Exactly.
Wow.
A roadmap for focus investing success.
Mm-hmm.
And the first rule is all about finding outstanding companies.
Right, and it's not just about companies that are doing well right now.
No, it's deeper than that.
It's got to be, something special.
It's about finding companies that have this edge, something that sets them apart.
So we're not just talking about trendy stocks or hype.
Nope.
Okay.
We're talking durable competitive advantage,
Okay.
a strong management team,
Gotcha.
a business model that's built to last. You need to understand the economics of the business.
Right, what makes them tick.
Exactly.
Yeah.
Assess their long-term potential. You're looking for companies that have a proven track record and, more importantly, a high probability of continuing to perform well in the future.
And then there's that whole less is more rule, which seems kind of counterintuitive, right?
Yeah. It goes against everything we've been told about diversifying.
I know. Don't put all your eggs in one basket and all that.
Right. But Buffett actually says conventional diversification doesn't make sense for the know-something investor.
Yeah, I remember that.
It's like, if you've done your homework and you really believe in these companies, spreading your bets too thin can actually hurt your chances of hitting it big.
So you're saying if you have a few really strong convictions, it's better to go all in on those than to water them down with a bunch of maybes.
Exactly.
Interesting. And this idea of concentrating your investments was something he picked up from Philip Fisher, right?
Yes. Another legendary investor. He really stressed the importance of deep research and understanding the businesses you own.
It's about finding those rare opportunities that have the potential to deliver exceptional returns, right?
You got it. Okay, so now we've found those amazing companies and we've resisted the urge to spread ourselves too thin. What's next?
Yeah, what do we do now?
Now comes the fun part. Big bets on high probability events. This rule is all about having the guts to invest a big chunk of your portfolio when you find that truly exceptional company.
Like Buffett did with American Express back in the 60s, right?
Yes, he put 40% of his partnership's assets into it.
Wow. That's a lot of eggs in one basket.
It was a bold move, but it paid off big time. And that's because it wasn't just a random bet.
He saw something that others missed.
Exactly. At the time, American Express was going through a rough patch. But Buffett saw that the core business was still incredibly strong. He saw an opportunity that others were too scared to touch.
So he wasn't just betting on the company, he was betting on his own analysis.
Exactly. It's about having a different perspective, seeing value where others see risk.
And having the courage to act on your convictions.
Absolutely. But remember, this isn't a get-rich-quick scheme. Focus investing is a long game.
Which brings us to another golden rule, patience, right?
Yes. This isn't about day trading or chasing trends. It's about holding on to those great companies for years, even decades, letting the power of compounding work its magic.
So no glued to the ticker tape, frantically checking prices every minute.
Not at all. This is about staying calm and focused, like Buffett. And I remember the book mentioned Charlie Munger, his partner, has this great analogy about poker and investing. He talks about how you need to know when to hold your cards, even when the pressure's on. And a lot of that resilience comes from his family, people who knew how to handle the ups and downs of life.
So it's about weathering the storm.
Exactly. And it's especially important when you're focused on a smaller number of companies because those price swings can feel more intense.
Makes sense. But how does all of this in-depth knowledge, these concentrated bets, this long-term thinking, how does it all fit in with the way most people think about investing?
Well, you could say that focus investing challenges some of the core assumptions of modern portfolio theory.
MPT. For those of us who need a reminder, what is that exactly?
Basically, MPT puts a lot of emphasis on diversification as the main way to reduce risk.
Okay.
It's about spreading your investments across a bunch of different assets.
Right, so that if one thing tanks, it doesn't bring down your whole portfolio.
Exactly. And in MPT, risk is mainly defined as price volatility.
So how much a stock's price bounces around.
Exactly. But here's where Buffett takes a different approach. He doesn't see those price fluctuations as the biggest risk. In fact, he often sees opportunity in those price drops as long as the underlying business is still solid.
Interesting. So he's not as worried about the short-term ups and downs. He's more worried about making a bad investment that could permanently lose money.
Right. For him, risk is about misjudging a company's future prospects, not about how much its stock price jumps around. It goes back to that deep analysis and understanding the real value of the business.
So he believes that if you focus on companies with strong fundamentals, companies that are built to last, you can minimize the risk of losing your money, even if their stock prices go through some rough patches.
Exactly. And I know the book also mentioned the efficient market theory, or EMT.
Oh, right. The one that says you can't beat the market because all information is already reflected in a stock's price.
That's the one.
Yeah.
But Buffett obviously doesn't buy into that. He actually sees those market inefficiencies as a good thing for his strategy.
So he's not just trying to match the market, he's trying to outperform it.
Absolutely. He believes that by doing his research, digging deep, he can find valuable information that the market hasn't fully factored in.
So he's looking for those hidden gems, the companies that the market is undervaluing.
Exactly. Companies that have the potential to deliver great returns over time. But is Buffett alone in this?
Yeah, are there other people who use this focus investing approach and actually succeed?
That's when we get to these super investors of Buffettville. These are people who've consistently done better than the market by using Buffett's principles.
They're like the proof that focus investing really works.
Exactly. And the book highlights some pretty amazing track records, like Charlie Munger, Buffett's partner at Berkshire Hathaway. He managed his own investments for years before teaming up with Buffett, and his returns were phenomenal.
So it wasn't just luck. There was a method to his madness.
Definitely. He built a focused portfolio of companies he really understood, and he wasn't afraid of a little volatility. He knew it was part of the process.
So he wasn't trying to time the market or jump in and out of stocks all the time?
Nope. He was picking his spots carefully and then letting his investments ride.
Okay, that's one super investor. Who else is on this list?
Another big name is Bill Ruane, founder of the Sequoia Fund. He is actually classmates with Buffett at Columbia Business School.
Wow, small world.
Right. And when Buffett closed his own partnership, he told his investors to put their money with Ruane. That's how the Sequoia Fund was born.
Talk about a vote of confidence.
I know, right? And their performance speaks for itself. They usually keep about 90% or more of their assets in just 6 to 10 companies.
That's some serious concentration. But it sounds like they're not just picking companies randomly.
Nope. They're still diversified. In terms of the industries they invest in, they just go really deep in those industries.
So it's about quality over quantity.
Exactly. They don't rely on Wall Street analysts. They do their own research, dig into the financials, get to know the management teams. It's all about finding those truly exceptional companies and then having the confidence to bet big.
Okay, got it. Who else is in this Hall of Fame?
Oh, we can't forget Lou Simpson. He managed Geico's investments for decades, and his returns were fantastic. The book describes him as having the perfect temperament for investing.
So what was his secret?
He was independent, didn't follow the crowd, and he loved digging into those annual reports just like Buffett.
So he was kind of the anti-Wall Street guy.
Very much so. He wasn't swayed by trends or hype. He was all about finding value and sticking to his principles. And get this, he managed a billion-dollar portfolio, but usually owned less than 10 stocks.
Wow, that's incredible. It proves that focus investing can work even on a large scale. But I'm curious, even with their amazing track records, did these super investors ever have periods where they lagged behind the market?
Of course. Even the best investors have those periods.
So it's not always smooth sailing.
Definitely not. Volatility is part of the game, especially when you're concentrated in a smaller number of companies. Those price swings can feel more dramatic.
So how do you deal with that? How do you not panic when things go down?
It's about understanding that those swings are normal and not letting them derail your long-term plan. You need to have that mental toughness.
Yeah, it sounds like the psychological side of investing is just as important as the financial side.
Absolutely. And that's something we're going to dive into in the next part of our deep dive.
Oh, I'm looking forward to that.
We'll explore specific strategies for managing your emotions and developing the discipline you need for focus investing.
Awesome. Can't wait. Okay, so we've talked about the philosophy, the big picture, but how do we actually make it work in the real world? When to buy more of those awesome companies and when to maybe sell?
Yeah, that's the tough part, isn't it? Knowing when to hold them and when to fold them. And the book really gets into how our emotions can mess us up.
Oh, totally. It's like 1 minute you're feeling all confident and long term, and then the market takes a dip and
And you want to run for the hills.
yeah, exactly. Like all that logic just goes out the window. Do you think that's why Buffett came up with that Mr. Market analogy?
Oh, absolutely. It's brilliant, right?
Yeah.
Imagining the market as this kind of crazy character always trying to buy or sell your stocks.
It's like he's got like mood swings or something.
Yeah, he gets all euphoric, then totally terrified, based on nothing but sentiment, not the
Yeah.
actual value of the businesses.
And we can't let ourselves get swept up in that.
No way.
Right.
If you make decisions based on Mr. Market's whims, you're going to end up buying high and selling low.
Which is the exact opposite of what we want to do.
Exactly. So how do we actually use this Mr. Market idea?
Yeah, how do we outsmart him?
Well, it's about realizing he's there to serve us. We don't have to take every deal he throws at us.
We get to choose.
Yeah. When he's being overly pessimistic, like offering us great companies at bargain prices, that's when we should be buying.
But when he's all hyped up, driving prices sky high, we need to be like disciplined.
Hold on to those winners. Don't get caught up in the frenzy.
Easier said than done, though, right? Especially when everyone's talking about this hot new stock.
Oh, for sure. It takes practice.
Hmm.
And that's where the circle of competence comes in.
Oh, yeah. The idea of sticking to what you know. But doesn't that feel kind of limiting?
Maybe at first, but it's actually freeing. Because by focusing on your area of expertise, you're making better decisions.
You're not getting distracted by all the noise.
Exactly. You can cut through it all and focus on what
The
matters.
fundamentals.
Right. So how do you figure out your circle of competence?
Yeah, is it just, like, if I'm into tech, I invest in tech companies.
Well, it's a start, but it's more than that. It's about figuring out which industries or businesses you really understand.
Like, maybe from your work experience.
Yeah, or your hobbies.
Or even just something you're passionate about.
Exactly. The key is being honest with yourself about what you know and what you don't.
And not getting tempted to stray outside that circle, even if everyone's talking about a certain sector.
Right, because if you invest in something you don't understand, it's basically gambling.
Makes sense. But what about when you start to get emotionally attached to a company or a CEO?
Well, that's a classic trap.
It's like you're rooting for them to succeed, not just because of the money.
I know. We're human, right? We love a good story. But we got to remember, we're investing in businesses, not fairy tales.
So no falling in love with a company.
Nope. It's about making clear-headed decisions based on the numbers, the competition, the long-term prospects.
Separating your heart from your wallet, basically.
Exactly. And speaking of tough decisions, being a contrarian investor is another challenging part of focus investing.
Going against the grain.
Yeah. It's hard to resist the herd mentality. But as Buffett's shown us, sometimes the best opportunities come when everyone else is running the other way.
Right, like that whole be fearful when others are greedy thing. But how do you actually do that? How do you stay calm when everyone else is panicking?
It starts with trusting your own analysis. If you've done your research and you believe in the company, don't let short-term market jitters shake your confidence.
So it's about having conviction. But how do you know if it's genuine conviction or just stubbornness?
That's a good question. You have to be able to question yourself. Be open to being wrong.
And not just blindly follow what everyone else is saying.
Exactly. Be skeptical of the hype, the news headlines, all of it. Develop your own filters.
Rely on your own judgment.
Yes. And that ties back into the circle of competence. If you're focused on what you know, you're less likely to get swayed by the noise. And this brings us back to patience.
It's a recurring theme, for sure.
It really is the key to focus investing. Not just waiting for the right opportunities, but also having the discipline to hold on, even when things get rough.
Especially when things get rough. Because it's so easy to get spooked when the market takes a dive.
I know, it feels like the world is ending. But the book reminds us, volatility is normal. We shouldn't let those short-term dips shake our long-term vision.
Right, because if the company is still fundamentally strong, a drop in the stock price might actually be a good thing.
Exactly. It could be a chance to buy more at a discount.
Like a sale at your favorite store.
I like that. As long as you trust your analysis, those dips can work in your favor.
So we need to reframe our thinking about volatility.
Yeah, it's not something to fear, it's an opportunity.
But that's, again, easier said than done, right? How do we actually manage those emotions and make rational decisions when everyone's losing their minds?
That's the million-dollar question. And it's one we'll be tackling in the next part of our deep dive.
Oh, good, because I need all the help I can get. So we've covered a lot of ground, but it all boils down to this. How do we stay sane when the market gets crazy? What are some, actual things we can do to keep our heads on straight?
Well, one thing the book emphasizes, and I think it's crucial, is shifting your perspective. Focus investing is about the long game. We're talking years, not days or weeks.
Right. Zoom out, look at the big picture. Don't get caught up in all the little blips along the way.
Exactly. And remember, the stock price isn't the same thing as the actual value of the business.
Yeah, it's easy to forget that when the numbers are flashing red on your screen.
I know, right? So it's about focusing on the fundamentals. Remind yourself why you invested in this company in the first place.
Because you believe in their product, their team, their long-term vision.
Exactly. And on a more practical level, it helps to limit how much you expose yourself to the daily market madness.
Unplug from the matrix, so to speak.
Exactly. Don't get sucked into the constant stream of news and predictions. It's just noise.
Yeah, it's like trying to quit social media. It's hard. But probably worth it for your mental health. And your portfolio's health.
Absolutely. Another thing that can really help is having a written investment plan.
Oh, yeah, like a roadmap for your investing journey.
Exactly. It forces you to think through your goals, your time horizon, how much risk you can handle.
So not just winging it.
Nope. Get specific. Define your criteria for choosing companies. What are you looking for?
Strong management team, a history of innovation, a solid competitive advantage. Write it all down.
That way, when the market throws a curveball, and it will, you can go back to your plan and get recentered. Remind yourself of your long-term strategy.
Like, okay, this is just a bump in the road. I'm sticking to my plan.
Exactly. And don't be afraid to update your plan as you learn and grow as an investor. Your goals might change, the market might change.
It's a living document.
That's a great way to put it. And, another thing that stood out to me in the book was the importance of having a support system.
Oh, yeah. It's easy to feel like you're in this alone.
It can be isolating, for sure. So find people who get it, who understand your approach.
Like other focus investors.
Yeah, or maybe a financial advisor who's on the same page. Even just a friend or family member who can offer encouragement.
Someone to remind you that you're not crazy for doing this.
Exactly. And it's not just about emotional support. It's about learning from each other, sharing ideas.
Like we're doing now.
Exactly. And we can learn so much from people like Buffett and Munger. They've been so generous in sharing their wisdom over the years.
And they've got the track record to back it up.
For sure. And the book highlights so many great lessons from their approach. Patience, discipline, independent thinking.
And the courage to go against the crowd.
Absolutely.
Yeah.
To challenge conventional wisdom, to trust your own analysis. But let's be real, even they make mistakes, right?
Oh, yeah. No, he's perfect.
Exactly. But the key is to learn from those mistakes. Adjust your approach. Keep refining your process.
Okay, let's talk about the elephant in the room, the volatility. It comes with the territory when you're a focus investor, right?
It does. But it's important to remember what we talked about earlier. Buffett doesn't see price fluctuations as the biggest risk. He's more worried about making a bad investment that loses money permanently.
So don't freak out about the daily ups and downs. Focus on the long-term health of the businesses you own.
Right. If the fundamentals are still strong, a temporary drop in the stock price shouldn't scare you.
It's about having confidence in your research.
Exactly. and knowing that short-term noise doesn't change the long-term story.
So we need to change how we think about volatility. It's not the enemy.
It's an opportunity.
But that's a tough mindset to cultivate, especially when everyone else is freaking out.
It is. But remember, even when your portfolio is down, as long as those businesses are fundamentally sound, it's still growing.
Growing behind the scenes.
Yeah, like a tree growing in the forest. Just because you don't measure it every day doesn't mean it's not getting bigger.
I love that. So, as we wrap up this deep dive into focus investing, what are the main takeaways? What do we want listeners to remember as they start their own focus investing journeys?
I think the biggest thing is to remember that focus investing is about finding those truly exceptional companies, really understanding their businesses and having the conviction to invest a good chunk of your portfolio in them.
Go deep, not wide.
Exactly. Embrace the long game. Don't chase quick wins, accept that there will be ups and downs.
Learn to manage your emotions, stay disciplined.
And keep learning. Refine your process. Find a support system.
It's a journey, not a destination.
Well said. And I think it's fitting to end with one of Buffett's most famous quotes. Be fearful when others are greedy, and greedy when others are fearful. Trust your analysis, stick to your plan, and focus on the long term.
You know, I think one of the coolest things about focus investing is that it's not just about making money, it's about aligning your investments with your values.
Oh, absolutely. It's about investing with purpose.
Finding companies you truly believe in and being part of their success.
That's a great point.
So who knows, maybe someday you'll be sharing your own focus investing success story. That's all for this deep dive. Thanks for joining us.
And happy investing.